Ladies and gentlemen, good day and welcome to the Chalet Hotels Limited Q4 FY21 earnings conference call. As a reminder, all participant lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Ruchi Rudra. Thank you and over to you, ma'am.
Good morning, ladies and gentlemen. Welcome to the Quarter 4 FY21 performance call for Chalet Hotels Limited. We have with us Mr. Sanjay Sethi, Managing Director and CEO, and Mr. Milind Wadekar, our Interim CFO, to take you through the performance and respond to your queries. Let me make the usual disclaimer on forward-looking statements. Kindly refer to our presentation, which has been made available on the stock exchanges and on our website for the details of the same. I hand over the line to Mr. Sethi to share his opening remarks.
Thank you, Ruchi. Good morning, ladies and gentlemen, and thank you for joining us for our earnings call of Q4 2021. We do sincerely hope that you and your dear ones are well in these trying times. Since our last interaction, the second wave of the pandemic has hit the country harder than anticipated, impacting lives and livelihood and forcing various state governments to take semi to full lockdowns. While the country battles the virus again, the vaccination drive in India has been making slow but steady progress. All age groups over 18 are now allowed to take the vaccine. However, limited supply of vaccines is keeping the progress painfully slow. India has fully vaccinated around 3% of its population, and another 11% of the population has received the first dose. To put things in perspective, the global vaccination status reports that 5% of the global population is now fully vaccinated. UK and US, both key markets for Chalet are reporting 30% and 37% fully vaccinated citizens respectively. UK is also targeting to remove all restrictions by 21st of June. Before the second wave hit India, domestic air traffic for the months of January to March had reached 60% of pre-COVID levels, indicating a strong bounce back. According to a recent report by Hotelivate, average occupancy in India reached 49% in Q4 FY21 as compared to 65% in pre-COVID levels, largely led by pent-up demand in the leisure space and showcasing, very importantly, the willingness to travel. The report has forecasted occupancy in India in FY22 to be 52.7% and in FY23, 64.9%, driven by demand recovery as well as muted growth of supply. For Chalet Hotels, the quarter started on a positive note. Q3 had witnessed a surge in social functions and pace of bookings, and that sort of continued on a sharp upward trend for Q4 also. F&B revenues started to pick up, and business travelers started trickling in. We saw an uptick in non-residential footfalls in restaurants and bars as well. Room business across hotels was a mix of quarantine, BCP, airline crew, staycations, project-related business travel, and large group businesses like film shoots and IPL teams. In January and February, corporate travel, small meetings, and conferences picked up early momentum. It was heartening to see pick up across sectors like manufacturing, IT, fintech, consulting, pharma, and entertainment. The second wave of COVID, which hit us hard, as I mentioned earlier, in the later half of March, brought most cities to a standstill, especially Mumbai and Pune. Domestic travel plunged and lockdown type restrictions were reimposed, impacting both room and food and beverage business. The situation in Mumbai and Pune seems to be improving now, and the peak of the second wave is behind us. However, restrictions in Mumbai and Pune have been extended till 1st of June. Current restrictions for Bangalore or Bengaluru are still till 24th of May, and for Hyderabad till 22nd of May. On the financial front for Chalet, our Q4 revenues grew sequentially by 11% to approximately 1.02 billion rupees. On an operational basis, our EBITDA grew by 11% to 187 million rupees. However, we had to account for loss of discontinued business at Orb, which is 13 million, and reversal of SEIS income of 123 million, dropping our EBITDA to 51 million for the quarter. I must highlight here that this SEIS income is still something that can work out sometime in future, but for accounting purposes, we have excluded it from our financial statements for the financial year. Ladies and gentlemen, Chalet has been able to report EBITDA positive numbers for all 4 quarters of the last fiscal. Our hospitality business revenues grew by 16% sequentially on the back of improved occupancies at 39% in Q4 compared to 33% in Q3. Jan and Feb actually recorded occupancies of 37% and 42% respectively. In March, however, with the rising number of cases and as the economy closed down in Maharashtra, our occupancies dipped back to 37%. Trends in April continue to be subdued for the portfolio. As most states imposed partial lockdowns, the portfolio had an occupancy of 36.5% for April. The RevPAR for the quarter 4 grew by 22% sequentially to rupees 1,610. Food and beverage division's share continued to be a healthy 38% of the reporting period. Our focus continues to be to work with the operators to create a compelling F&B offering at all our outlets, as well as through food deliveries via channels like Marriott on Wheels, Swiggy and Zomato. Our cost control measures taken throughout the year have kept fixed costs at around 50% of previous year's level for the hospitality division. Our operating teams managed to reduce fixed costs by moving certain fixed costs to variable buckets. A few strategic initiatives like centralizing of finance hub, outsourcing non-core activities like laundry service of our 2 large hotels in Mumbai resulted not only in improving efficiency but also helped lower costs on an ongoing basis. Through a continued emphasis on staff productivity, the staff to room ratio continues to hold at 0.74 employees per room for the second quarter now. This ratio was 1.18 employees to a room in December 2019. You will recall that we had reacted swiftly in Q4 of FY20 to work on this fixed cost and had already brought the ratios down to 1.08 employees per room as early as March 2020. Utility, the other big cost hit, where we achieved significant savings. Our hotel portfolio managed a 46% annual reduction in electricity units consumed per room in FY21. These efficiencies have also been driven over the last few years by our mission to go green as a company. We have recently applied for sign up for the EV100 initiative, which focuses on accelerating transition to electric vehicles under the aegis of the climate group. We are further exploring our eligibility to participate in EP100, which is on energy productivity, and RE100, which is on renewable energy. I'm very happy to share that on renewable energy front, our energy consumption has now moved to 51% of our energy coming through green sources as against 43% in Q3. Variable costs are also in line with revenue levels and were down by 70% for FY21. On the non-hotel assets, rentals from our commercial tenants continue to be unaffected and provide steady cash flow. We have, however, given some relief on CAM and parking area charges, which is basically passing on the savings that we've had on the CAM charges. On the retail front, footfalls did improve at the Inorbit Mall in Bangalore for Q4. Subsequently, the business has been impacted by the reimposition of the lockdown measures in the state. The Orb at Sahar has largely been inactive throughout the pandemic, and we are currently in the process of repurposing that space. Majority of the area is being converted to commercial offices. Select few F&B outlets will continue to operate, providing necessary F&B product to the office occupants. A short update on the project pipeline. Except for the slowdown in the last few weeks, 2 commercial development projects are progressing well. The lobby renovation at Renaissance has been completed, and the new lobby has been operational since January 2021. I had mentioned this in our earlier call too. We have had excellent feedback on the renovated lobby. The balance renovation of the hotel will be undertaken over the next few months. The new lockdown measures have made us defer our plans for Hyderabad's second hotel for now. The pending work on site, as I shared earlier, will take approximately 5 months for completion from the restart date. We will right-time the project to align with demand dynamics. Similarly, the need for commissioning additional 88 rooms in the hotel will be reviewed on an ongoing basis and executed at an opportune time. Our employees have been a pillar of our strength. By and large, they have been safe, and positivity rate is below the national positivity rate, in spite of them being on the front line. We unfortunately lost 2 employees in May and June of the last year. Our operators and we at our corporate office have worked diligently to ensure COVID safety protocols and extend all help needed by our associates when needed. We are grateful to the team at Chalet across all its properties and the corporate office who have worked tirelessly in these difficult times to continue to serve our guests with a smile. In line with that, I'm happy to share that Chalet Hotels has for the second consecutive time been certified as a Great Place to Work by the Great Place to Work Institute. Ladies and gentlemen, over the last 1 year, one thing that we have learned is that there is no crystal ball. Businesses are faced with multiple concurrent forces that need to be handled with unrelenting navigation of new challenges. There's clearly no straight path forward. We at Chalet are committed to being nimble on our feet and have an undeterred resolve to come out of these challenging times and deliver industry-leading returns in not too distant a future. I now hand over to Milind to take you through some of the key numbers.
Thank you, Sanjay. Good morning, ladies and gentlemen. As discussed by Sanjay, the fourth quarter started on a strong note, and we could see business performance improving month on month. With the second wave hitting in March and lockdowns imposed by various states across the country, we saw public sentiment weakening. As I elaborate on this, let me give you some insights into our financial performance. Quarter 4 FY21 total income grew by 11% sequentially to rupees 1021 million. Quarter 4 FY21 EBITDA from continuing operations is rupees 64 million as against rupees 169 million for previous quarter. The drop was on account of reversal of SEIS income of rupees 123 million for the previous year. Adjusting for this entry, the EBITDA for Q4 is at 187 million, a growth of 11% sequentially. For the quarter ended March 21, we have accounted for a loss of 13 million from discontinued operations at Sahar Retail. The loss was largely on account of rebates given to existing retailers as we decided to repurpose the space and close existing contracts. PBT from continuing operations post charges on depreciation and interest for the company was a negative of 585 million as against rupees 500 million in Q3 of this year. After taking credit for deferred tax asset of rupees 338 million, PAT loss from continuing operations was at rupees 247 million. Hospitality. The hospitality segment contributed to 71% to the total income of the company in Q4 FY21 as operations continued to scale up through the quarter. The revenue grew by 16% on a sequential basis to 724 million, with positive EBITDA of rupees 19 million for the quarter. A second quarter of positive hospitality EBITDA in FY25. Occupancy for the quarter averaged at 39%, up by approximately 600 points, and RevPAR was at 1,610 as against rupees 1,318 in quarter 3, a growth of 22%. Food and beverages division's performance has picked up with contribution of 38%. Late March onwards, there was direct impact of second wave on the dining services of the hotel. On the cost front, as mentioned by Sanjay, the company has achieved fixed cost reduction of 50% as compared to previous year. The fixed cost for the year have been at an average of 11 to 12 crores a month. Variable costs have been down by 70% for the period. The variable costs are expected to rationalize as operations scale up, whereas our strategic initiatives on cost will keep the variable cost contributions lower than traditional levels. The company has signed power purchase arrangement for hotels in Maharashtra to source renewable power from third parties. The arrangements are for a period of 10 years, which will have a fixed rate for first 6 years. These rates are currently at a discount to applicable industry rates in Maharashtra. This will result in reduction in HLP cost of hospitality segment in the years to come. Total expenses for the quarter were lower by 46% as compared to the previous year and were higher by 17% as compared to Q3 FY21 as operations scaled up. Retail and commercial. Steady income from commercial assets have kept the revenue and EBITDA from retail and commercial segment at rupees 258 million and rupees 215 million for quarters respectively. With the conversion of large part of the ops at Sahar, Mumbai to commercial office space, we will be hedging the portfolio further. The new setup is likely to be EBITDA and return ratios accretive. For the financial year FY21, total income was at 3167 million. Total expenses for the period were at 2873 million, a drop of 55% from the previous year, and the EBITDA was at 249 million from continuing operations. Adjusting SAI's income return back of rupees 123 million, the EBITDA for the year is at 417 million. Treasury. Net debts on book as on March 21 was at 18,704 million as against 16,570. That is, it has gone up to 1870 crores from 1657 crores, a total increase of around 213 crores for the period. The capex spent during FY21 was at 115 crores. Our cash burn, that is EBITDA less finance cost, for quarter 4 FY21 has been at 301 million, while for the full year it has been at 1267 million, that is 126 crores, led by prudent cash flow and working capital management. The average cost of rupee loan is now at 8.04% as against 9.72% at the beginning of the year. 54% of our loans are at sub 8% interest rate for the company. We have cash and cash equivalent of rupees 67 crore as at March 21 and 725 crore sanctioned lines of credit for general corporate and planned capex. Korabangla project. There has been no new subscription from promoters on 0% non-convertible redeemable preferential for funding the outflow relating to residential project at Korabangla during the period under discussion. With this, we now open the floor to questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. first question is from the line of Aditya Bagul from Axis Capital. Please go ahead.
Hi. Good morning, Sanjay, Milind sir, and the rest of the team. I hope all of you are doing safe and well. So my first question is in terms of our occupancy, right? We've seen 39% odd occupancy this quarter. Just wanted to understand some texture to this. What was the numbers? If you can give us a glide path as to what this was in Jan, Feb, March, that would be helpful. And in the same context, some of the industry bodies, as you mentioned, are talking about a 55% odd occupancy level for FY22. Just wanted to get your sense on how this will be spread out during the year. Does this mean a closer to 60-65% occupancy at FY22 exit? And if you can just throw some color on how you look at MMR versus the rest of the cities. Thank you.
Thank you, Aditya. Yes, we are doing well. I hope you are too. So to answer this side, whilst I did share the overall occupancies for month-wise, let me give you a flavor of how the occupancies panned out for the quarter between the cities. So the Mumbai region, which includes the Renaissance Hotel, the Marriott Executive Apartments, the Four Point Sheraton, and the JW Marriott at Sahar, had a Q4 occupancy of 39%. Bangalore, which is a Marriott Whitefield in Bangalore, had an occupancy of 35%. Hyderabad was poor at 27%, and Pune did an occupancy of 63%. So this sort of combined gives us an overall occupancy of 39%. As I mentioned, the occupancies had picked up sharply in January and then very well in February, where we hit 42%, but then came back to 37% on account of the second half of March being lost. Just to give you a flavor, what was happening was over January and February, the pace of bookings, and I did sort of allude to it in my opening conversation also, was looking very healthy in January and Feb. In fact, we saw domestic business travel starting to come back. We saw social functions, especially weddings, very, very healthy. We had two large groups booked at our hotels, one in Sahar, one in Renaissance. One was the Mumbai Indians IPL team, which was to stay with us for almost about 65 to 70 days during the IPL when it was all supposed to be in Mumbai. They were to start from mid-March. But then the IPL got shifted to 7 different cities, and that one city sort of scenario went out, and therefore they had to move out. And then subsequently, we got a very large group of almost 370 rooms starting end of March at JW Marriott Sahar from the people who were doing the television coverage of IPL. And that was supposed to be there for 2 months too. Therefore, if you look at our April occupancies, actually, Sahar ended up doing 72% occupancies. This group was supposed to continue till end of May, but with the calling off of the IPL, they left sometime in, for the first week of May, and therefore we've had some challenges there. I think April, May will, April's already gone by, with, as I mentioned, at 36.5%. May will be, subdued. Depending on how the lockdowns move, I think June and the subsequent months will look better. Will we come out at 62% at the end of FY22? Given the Q1 performance of the hotels, it is unlikely that we'll be at 62%. But we do believe that the H2 will be strong. We see a strong recovery because there seems to be a lot of pent-up demand, both on business travel and on the MICE business, especially on weddings. Just to give you a flavor, there were 13 weddings alone in Renaissance in April itself. They all had to be called off. And clearly there were smaller ones, but when they do open up and they come back, they'll probably, likely to be much bigger weddings. The other thing that's happened is that Bangalore and Hyderabad which had a second wave that hit it much later, and their restrictions came into play much later, have clearly, going to take slightly longer to recover. Mumbai seems to, from a COVID cases count perspective, seems to have done extremely well. And we are very hopeful that there will be some easing off of restrictions post the 1st June situation right now, and as far as Mumbai and Pune are concerned. Our business has largely come out of groups that we were able to capture, and these were very competitive groups available in the market. Our team's done an excellent job of picking them up. The Renaissance was helped on account of that in March, and JW Marriott Sahara on account of that in April. Did I miss something out?
No, I think you were fairly elaborate in your answer. Just one point, if you can also talk about how do you see the ARR trajectory going along with the occupancy, and that would be very helpful.
So the ARR occupancy has been different. Trajectory has been different across cities. Mumbai is clearly reporting the highest ADRs in Q4 at roughly around 4,600 or so, and followed by Hyderabad, Bangalore. Pune has been low. Pune ADRs have been sub 3,000, just under 3,000 actually. But it has done occupancy of 62%. And then, at one point, this hotel was doing 75% occupancies in the last few months. There was clear pickup happening there. I think occupancies will not pick up at least for the next quarter. It's going to be a competitive landscape outside. The quarter after that, we may see some pickup in rate ADRs, and I think quarter 4 will come out strong in ADRs, and by then, hopefully, when the foreign travelers start coming in, we will see much higher traction on the ADRs also. Aditya, I must also point out, I think one of the reasons, and you did say, was the other companies are reporting higher occupancy numbers. The two factors that play that. One is we have all our hotels in the business segment. Yeah. We, of course, have the benefit of hedging the risk in having investments in the commercial office spaces, which becomes our counter to leisure for now. And it is giving us steady yields. The second element is all our hotels are very large. So that clearly helped on economies of scale from a cost perspective earlier, but when the markets are tight, your occupancy percentage tends to be lower because the available room nights will be finite in every city, and every brand or hotel is fighting for those finite room nights. So if we do, say, as I said, Mumbai did about 40% occupancies. It's on a base of a very large room inventory. And therefore, the number of room nights that we were able to garner as a company or from by our operators was significantly higher than many of the other operators in the city.
Understood, Sanjay. That was very elaborate. Thank you so much, and wish you all the best.
Thank you.
Thank you. The next question is from the line of Giriraj Daga from KM Visaria Family Trust. Please go ahead. Mr. Daga, your line is in talk mode. Kindly go ahead with your question, please.
Hello, am I audible?
Yes, sir.
Yeah. So my question is regarding two questions. First, on our fundraising side. So we had talked about 100 crore of and plus 600 crore of long-term fund. I'm sure looking at our balance sheet and our strength, we must be looking to consolidate our position. If you can throw some light there, what is the purpose of this fundraise and how we are looking to utilize this? Are we looking for some consolidation, some M&A happening side of the business?
Sorry, apologies for this, but I couldn't hear the first question clearly. Right, none of us could. Could you just repeat that, please? Thank you.
Am I audible now? Hello, am I audible now?
Yes, sir, you're audible. Please proceed.
So my first question is, we had talked about the fundraising, 100 crore of fund plus 600 crore of long-term fund. So I just wanted to understand what is the purpose of this fundraise. We must be surely looking for a consolidation in our business, given the distress available outside in our industry. So if you can throw some light there.
Yeah, hi, Giriraj Millit here.
Yeah.
See, we are raising 100, we have taken enabling resolution for raising 100 crore rupees preference shares. Now, this is for our one of the litigated Koramangala residential project, where any expenditure on this project are funded by promoters. So, as and when we require funds, we'll raise this money and it will be funded by promoters. And other fundraise of 600 crore rupees will be in the form of debt, and that is for the planned capex.
Okay. So any thoughts on consolidation, or is it as of now too early?
So early days yet. We do believe there will be opportunities, and when the time is right and the opportunities are there, we will make plans for that. But there's no specific, something that we are following right now.
Okay. My second question is on the, you mentioned about the cost cutting exercise or cost reduction initiative. So I just want to understand in simple language, let's say, so we had a CY19, which is from January 2019 to December 2019, when we had a normalized operation. Mm-hmm. We had about 930 crore of revenue and 376 crore of EBITDA in the hotel segment. Mm-hmm. Now, assuming when we reach this run rate of 930 crore hotel revenue, what will be the EBITDA at that point, given the cost initiative we had taken in the last 1 year?
Sure, good question. As we mentioned earlier, I think the key to this question is that we managed to bring some of our fixed costs down and convert some costs that were fixed in nature into variable costs, which allows us a lot more flexibility as things go forward. So the fixed costs will continue to be fixed, and therefore we will continue to benefit from that in the mid to long term. To answer your question specifically, if you were to hit, say, 950 crores of top line revenue, will we be able to deliver higher EBITDA percentages? Yes, we are very confident of that. But these are forward-looking statements, so I don't want to dwell too much on the details of what the numbers will look like.
Sure. Thanks a lot for my side.
Thank you. Before we take the next question, a reminder to the participants, please limit your questions to 2 per participant. Should you have any follow-up, may we request you to rejoin the queue. The next question is from the line of Amandeep Singh from Ambit Capital. Please go ahead.
Sure, sir. Thanks for the opportunity. So, sir, firstly, in Mindspace REIT's presentation, they mentioned about rent commencement from pre-leasing Hyderabad Hotel to Chalet 3Q FY22 onwards, but you are still evaluating the demand dynamics to recommence the balance work. So in that context, can you help us understand on what would be the exact arrangement here?
So, Amandeep, thank you for the question. Yes, there's rent commencement date that was agreed between these two companies quite some time back. And at some point of time, the rent will start. The assessment that we are doing is what's our best case scenario. Do we open the hotel, pay the rent and incur losses, or do we continue just paying the rent and not incur larger losses? So from that perspective, we'd like to pace it out, take the right decision based on what is the best way forward for us. So the total rent for a year is roughly around 9 crores, and if we delay this by a quarter or so, the impact 4 months, the impact could be about 3 crores. So that's something that we will take a call on. We may have to take a little bit of a hit on that, but these are signed off agreements between the two entities, and we don't really have a way out.
Sure, sir, that's really helpful. And so, slide 3 of your investor presentation indicates that Chalet lacked the recovery in Mumbai and Hyderabad micro market versus the industry. So could you help us understand what could be the possible reasons in terms of lower than region occupancies and ADRs?
Sure. So I think, as I mentioned earlier, and to answer Aditya's question earlier, the occupancy percentages are base of are dependent on two numbers: how many rooms are occupied, and what's your room inventory. Now, the room inventory in all our hotels, and that's been something that we've talked about as a strength in the past, has been that Chalet has had larger room inventories per hotel. Our average room inventory is in excess of 400 rooms per hotel, which is significantly larger than other hotel companies. And because there is finite business in every city, and even if you get more than a fair share per hotel of the finite business, you end up with lower occupancies. And that's what's happened with us. And because you're fighting for larger groups, because you have large hotels, sometimes the rates are more subdued, and therefore those rates also look slightly lower. If you were to look at the overall 21 performance, FY21, we had for almost about 2.5 to 3 months, doctors stay with us with room rates that was sub 2,500 for us. Some other hotel companies may have got higher rates or subsidies. We are not aware of that. But these are certain factors that have affected it. We are making sure that our goal should be occupancy. We are going to follow an occupancy-led strategy for the next 1 year at least, as against the rate one. And we've had Mumbai has shown RevPARs being lower than the competition, as I said, largely driven by occupancy drops. Bangalore has shown RevPARs higher than the market. Hyderabad is slightly lower than the market, but then that's driven by the fact that we did not take any COVID positive business in our hotel. As a policy, we have taken a call that we will not take COVID positive guests in our hotels across any of our cities. Some hotels have chosen to take them. And in Pune, we have again been above market. So Bangalore and Pune, we've been above market on RevPAR basis. Hyderabad lower on account of not taking COVID guests, and Mumbai largely lower on account of very large inventories of hotels.
Sure, sir. Thanks for the detailed explanation. I'll come back in the queue.
Thank you. The next question is from the line of Vikas Ahuja.
Yeah, hi. Hi, Sanjay. Hi, Nilan. Thank you for the opportunity. I have two questions. The first one is, clearly the second wave has dented the expectation of recovery in FY22. But internally, how we are seeing, when should we expect to move back to maybe, pre-COVID level revenues? And obviously, the Western countries are opening up and the chances of third wave looks bleak there. But how we are looking at recovery in India, any color around would be pretty helpful. I know, partially you have already answered in your opening statement, but if anything you can add. And my second question is, what are our CapEx plans for next 2 to 3 years? And maybe also if any update on revised timelines on hotels and office block openings. Renaissance, why you already said it's on track, but what is the status of W? I mean, is it on hold indefinitely? So ideally, we should remove the capex and revenue assumptions from our models. Western Mindspace, can we assume it will come fully in the second half of FY22? Also, any update on change in timelines for maybe Hyatt, Aurora, Powai, Block, etc.? Thank you.
Thank you for those questions, Vikas. Let me answer the first one to begin with. Color on the future. As I said in my opening statement, one thing you realize is that there's no crystal ball available to any of us. Everything seemed to be going extremely well in the later part of second quarter last year. Later part of third quarter last year, and the beginning of the fourth quarter this year. And we were extremely positive that we're going to be out of the woods in the next 3-4 months' time. But then the second wave hit us. Now, I have no knowledge. I cannot claim to have any knowledge on the medical front. People are predicting a third wave. People are saying we'll not have a third wave because we're well prepared. The vaccination drive is going to, reduce the chances of any significant impact of the third wave. But our vaccination is slow. So from our perspective, how we are looking at it is the following: that we believe the current and the next quarters are going to be subdued. Current quarter more so. Hopefully in the next quarter or later this quarter, current quarter, we will see opening up happening. Business will come back cautiously. It'll probably come back to how it was in the early fourth quarter. But will it come back to 50, 60, 70% occupancies? I doubt it right now. That hope or that expectation is only in H2 from our perspective, that we will see significant pickup in the quarter starting or the half starting October 2021. And that will largely be dependent on what shape and route the COVID-19 takes from here onwards. Clearly, as I mentioned again in the opening statement, the two key countries that are critical for Chalet, US and UK, have done very well on the vaccine front. And they seem to be extremely confident that the population that's vaccinated is largely safe from any serious impact of COVID-19. That gives us a lot of comfort, because that means that if they can move around freely within their countries, irrespective of whether others have got COVID or not, that should hold true for other countries. Obviously, India has taken some really bad PR hit over the last few months or few weeks. But we are hopeful the memory will be short on that. And as things improve in India and numbers go down, and yesterday's numbers are very encouraging. There's a sharp dip in number of COVID positive cases. We believe that business travel will be back strongly too. One indicator, I think, for us is, once we see that leisure travel picked up early, that indicates people are willing to travel, whether it is aircrafts or hotels. The current lockdowns have restricted them from travel, and some of the destinations which have got affected has restricted them from travel to them. But the willingness to travel is high, and that will be consistent for leisure as well as business. So we're confident that that will happen. I think FY23, FY24, FY23 will be a strong recovery year. FY24 should be normalized fairly well. To answer your question on the projects, Renaissance renovation is going on, as I mentioned. The phase 3, which was the office building, which is about 750,000 square foot of leasable space, is progressing well. We had a bit of a slowdown in the last 2-3 weeks. Slowdown in the sense the number of labor on site is not as many. We have 600 people on site, right now 300, but this impacted us maybe for 3-4 weeks. But it's progressing well. And the delay on account of this blip is actually, will be covered in the buffer that we had kept in the announced dates of opening. Bangalore may be delayed by a couple of months, the Bangalore office tower, because there the labor hit is stronger. And to get them back and restart and remobilize may take slightly longer. But I think Bangalore may be delayed by a max of 3 months, I think, as the office building tower stands. On WPY and Hyatt Regency, for now, I don't see us starting this construction in the next 6 to 9 months. So therefore, you'll have to build in your numbers 24 to 30 months of build-out time, maybe 24 months actually, because approvals and designs are already build-out time for them. And we will review W also, depending on demand dynamics, whether it makes sense to go down that route or we should look at alternative options. Western Hyderabad, as I mentioned earlier, we have 5 months to start that project. We'll continuously review this on what's happening in the demand dynamics. Next review probably in mid-June, and then remobilize if required. From your perspective, I would, from our perspective, we'd actually suggest that since we haven't started and we still to review that, we are at least 7 months out from opening that. So keep that as a perspective. Finally, on the numbers or any incremental costs, I'll ask Milind to give you any further. We don't have any material or significant increase in costs on these projects. Some IDC may have gone up on the spent amount. Beyond that, Milind, if there's anything else you want to highlight.
So, Vikas Milind here. As mentioned by Sanjay, based on demand dynamics, we'll determine the capex plan for Western Hyderabad. And our estimated capex for the year is 350 crores or so. Major component is for commercial offices, both Powai and Bangalore.
Sure, that's really helpful. Thanks a lot.
Thank you. The next question is from the line of Amit Agarwal from Nirmal Bang. Please go ahead.
Hi, thanks a lot for the opportunity. My question firstly relates to the mall which you have in Bangalore. Given the current, slowdown and closure, have you been under renegotiation with your tenants out there? And if so, can you show any color which side is it progressing and how do you expect it to move? Point number two, I was expecting F&B to do a much better than what you've done in the fourth quarter. When I look at the numbers, third quarter and quarter-on-quarter comparison, I see F&B revenue. Now, correct me if I'm wrong. In third quarter was 26 crores and fourth quarter was 27 crores. So not much of a growth we've seen there. So any light you can throw on these two aspects? Thank you.
Thank you, Amit, for that question. I'll answer the F&B one first, and then Milind will take the Inorbit one. As I mentioned, Mumbai went into lockdown late March, but restrictions on banquets and the worry on banquets and F&B came in slightly earlier. So with our Mumbai hotels hit hard in March, we didn't see the expected growth for the quarter because of the March impact and that almost two-thirds of our inventories between Mumbai and Pune. Jan and Feb had shown very healthy growth. Unfortunately, do we have the numbers in front of us somewhere? Maybe I'll give it out after Milind sort of covers that part. So that's what the net impact has been for the business. I just got the F&B numbers of our hotels in front of me. So January, we had 8.5 crores of F&B. February had increased by almost 25% to 10.5 crores. But then March fell to 8.3 crores again. So clearly that, that trend, that line that was beginning to build up, strong and healthy, did not happen. So 85 to 105 and then down to 83. If that trend line had continued, and remember February was only 28 days, the March following that trend should have been in the range of about 13-14 crores. That 13-14 crores would have added another 4 to 5 crores, 27 crores, taking it to somewhere between 32 to 33 crores, which would have again been a good jump over Q3.
Amit, Milind here.
Yes.
So for FY21, we had EBITDA break-even at Inorbit Bangalore. Footfall started improving from December, and we were expecting it will go up in the current first quarter of current year. But since lockdowns are imposed, again, retailers will approach us and will negotiate case-on-case basis. But we had estimated positive EBITDA for the year, but we'll see how it pans out based on lockdown conditions in Bangalore.
Yeah. My question actually pertains to the, as we move forward, like what happened last time, retailers had approached the mall owners and there's some kind of agreement on that. Has the same thing started now, because whether it's Bangalore, Mumbai, malls are closed all over. So for your mall in Bangalore, have the retailers approached you and have you come to any kind of agreement in terms of whatever, waiver of, fees or whatever? Anything on that?
No, Amit, there's been no such discussion so far.
Sure. Thanks a lot. Please show from my side. I'll come back in.
Thank you. The next question is from the line of Sumant Kumar from Motilal Oswal. Please go ahead.
Yeah, hi, sir. So we have seen in Q4 there was a increase in employee cost. So as per your PPT, payroll cost as a percentage of revenue increased from 28% in Q3 to 29%, right? So that's number one. Number two, overall fixed cost reduction in FY21, you have highlighted 50%. So can you tell us what percentage of cost cutting is going to sustain over 3 to 4 years?
So I did sort of allude to this, the answer to this question a little earlier. I'll try and sort of answer it again. The fixed cost, a large percentage of the fixed cost reduction will continue in the coming years because the employee productivity numbers have improved significantly on the back of 2-3 exercises. One, we've clustered some services. Number 2, we've centralized and outsourced certain services. Number 3, we've reconfigured processes and systems and automated a few things to allow us to work with lesser number of people. Now, all this will continue, and therefore, we expect the productivity levels to be high for times to come. The certain other costs in terms of variable will also continue to be even if the revenues go up. Just to give you a reference, over the last 1.5 years, we worked with the brands of localizing all procurement items. So consumables like bathroom amenities, room amenities have all been localized. We are working on establishing our in-house water bottling plants. That's more from an environment perspective, but the outcome of that is that our payback will be around a year. So we'll actually have reduction in operating costs there too. Similarly, we've had some energy initiatives in the company which have improved efficiencies of energy consumption, and all of them will help keep our costs low as we go forward. Laundry, I've already mentioned earlier that this has been one item that we've outsourced, and our efficiency on a cost per kg of laundry has improved also significantly, plus we were able to reduce the number of employees that we had. Finally, I think the one big ticket item is that we worked hard with the brands, the global brands, to pick up some of the best practices that were available globally and incorporate them. Like there could be change in patterns of how people travel in future, there's also going to be change in patterns of what the services will be offered in hotels. When I mentioned automation, we do expect in future all our guests, at least a large percentage of the guests, will actually be using handheld devices for checking in, using that as a key, for concierge services, for any engagement with the hotel team, and for checking out. Practically, we expect that over the next 2-3 years' time, we will probably do it with the front desk as a whole. You will have some lobby, people in the lobby, which are like guest relations executives, who are going to be freely engaging with the guests in that area, but not having proper front desk for check-in and check-out. That will reduce employees 3 times over because of 3 shifts that man the reception counter, and there are multiple counters at each hotel. So these things are going to be there good for future, and we do expect a large part of it to continue. Another thing that I mentioned was that some of the fixed costs have been converted to variable. So that fixed to variable, laundry is a clear example of that, helps us navigate any crisis that will come in future. So our costs will not be the fixed cost of running the laundry machines, running electricity there, and paying wages and salaries for the laundry employees. That will be now the laundry operators' requirement. Ours will be payment on a per kg basis or per unit basis. So therefore, our costs will come down. I hope I've addressed your question. I'm not giving you numbers because I think again they will be perceived as forward-looking numbers.
So can you talk about the 50% reduction, and then you have a payroll cost also, and the payroll cost you have cut the overall ratio of the employee to room, but what about the cost measurement? Whatever the per employee cost cut you have done, how it is going to reverse when the good time will come?
So I think I'm sorry, I missed that part of your question. You'd asked that earlier also, that you saw an increase in payroll costs between the previous quarter and the current quarter that we reported. The reason for that was that we reduced some of the salary cuts for the employees. And therefore that cost went up. There could be some creep up on those costs, on the payroll costs, because there are some amount of salary cuts, which is basically a reduction in number of days that employees are coming to work, which are currently in play. But it's not going to be material in nature.
So my understanding, compared to industry, your fixed cost reduction for 3-4 years will be a lower, whatever the industry is has already cut.
No, our cost reduction will be higher purely by the fact that we are now operating at 0.74 employees to a room. So let me give you a reference point here, Sumant, on this. One, pre-pandemic, I think the reported numbers for the industry for upper upscale and luxury hotels for productivity were 2.1 employees per room in our segment of hotels. At that time, Chalet used to be 1.18 to 1.2 employees to a room. So we were, about 40-45% more efficient than the rest of the industry combined together. We have since then brought it down from 1.18 to 0.74. Now that's a reduction of 18 and 26. That's almost 44 on a base of 118. That's almost 40% reduction in number of employees. So, that gives you a clear reference on which way things are heading. We do have significant savings. The other thing that Milind had touched upon was the power cost. Now that's something that we've been working on for a while now, and we're happy to sort of announce, as Milind mentioned, that we've signed an LOI for power purchase for the next 10 years. That will not only help us take that 51% of renewable share even higher than where we are today, but it will also bring our blended cost per unit lower than where we are today.
Sumant, Milind here. Just to give you perspective, we were sourcing our power from third-party generators, and it was at discount to around 30% of commercial rate. Now we are expecting industry rates will be applicable in the next 1 or 2 months, and our new arrangement is at discount to industry rate. So as compared to our previous purchase price, it is 30% lower, and there will be some discount to industry rate, so which will bring down our power cost substantially.
Okay. Thank you.
Thank you. The next question is from the line of Priyanka Yogesh Khandelwal from ICICI Prudential Mutual Fund. Please go ahead. Seems like we lost the connection for the current participant. We move to the next question from the line of Jitu Punjabi from EM Capital Advisors. Please go ahead.
Hi, thanks so much. You really appreciate this. So 2 questions. One, more a micro question. What's your total debt as of today, and what's the plan on that? I mean, how do you kind of take that forward over the next year or 2?
Our gross debt position as on date is 1940 crores to be reduced by cash equivalent. So we are at around 1875 or so, and we have planned capex of around 350 crore rupees for next year. So there will be some addition in debt in FY22, but that depends on how capex pans out.
Okay, understood. And the second question, I mean, I've heard a lot of the moving parts on occupancy and ARR and everything else that's going on. Can you just take me through what's the thinking at the board level or at the family level? How do Ravi and Neil, or how does the founder think about this business from a 3-4 year perspective? What's the bigger picture game plan, and what do we plan to do this over the next 4 or 5 years? Where do we plan to take this?
Thanks, Jitu, for the question. This is Sanjay here. I think, and we just finished the board meeting yesterday, right? This is fresh off the table. From our perspective, we get a lot of comfort from the backing of the promoter group, a very strong promoter group. So from that perspective, we have no stress at all. We've have the benefit of real estate expertise within the group, and Chalet has three types of assets within its portfolio: hotels, we've got malls, and we've got office spaces. The office space real estate division has been doing extremely well. And our general belief is that that's more stable in nature than retail. And on the back of that strategy, we converted all, and we're converting majority of the all, which is at JWSR, Mumbai, into office space. Just as a reference, the total area that we have in all is about 11,200 square meters, and 80% of that will be converted to office space from F&B and retail. Roughly around 2,500 square meters will continue as F&B and retail. This decision is taken on the back of the knowledge that sits within the group. And we are able to sweat the asset, diversify our risks on the back of the real estate expertise. We believe that the hedge that we've done of having a certain amount of assets in the office side has been the savior in the last 4 quarters. That's actually helped us deliver 4 consecutive quarters of EBITDA positive results. We believe going forward that will continue to be strong. And if you heard the earnings call yesterday of the Mindspace Business Park, they've done an excellent job of leasing and releasing spaces even in the last quarter. The belief is the following, that good quality A-grade office spaces at the right location will continue to have high demand and a premium to rents. With that in mind, was taken. With that in mind, we're building the large office building in Hawaii, and with that in mind, we're building the office tower in Bangalore.
Okay. So just from a focus perspective, am I hearing this right? That from a hotels and a retail perspective, you want to keep a little, but manage it very well over the next 3-4 years, and a lot of incremental capital will go into office space. Did I hear that correctly, or did I?
Jitu, if you look at our current capex plans and our projects, that's true. Majority of the capex plan is actually going into office spaces. We had 3 hotels which were supposed to be in the pipeline. Given the demand dynamics, obviously we're following a wait and watch strategy on that. But hospitality will continue to be the majority of the business, as even with 39% occupancies, hospitality revenues has now crept back to 70% of the total revenues of the company. And when things do stabilize in 2-3 years' time, we expect revenues in hospitality to be about 75% of the revenue, 25% of it coming through office and retail, majority of it coming through offices actually.
Jitu, let me add here, on incremental capex for office space, we are expecting high teen returns. So we are raising debt at 8.25 today, and we are expecting a very high returns. So we want to use this time, uncertain time, for building commercial assets.
Okay, understood. Fair point. Thank you so much. Thank you, everybody. Really appreciate this.
Thank you.
Thank you. The next question is a follow-up from the line of Amit Agarwal from Nirmal Bang. Please go ahead.
Thanks for the time. Just a quick follow-up. Honestly, I don't know what is SIES income. So can you just explain me what is SIES income for?
SIS is service exports from India scheme. So we are entitled for 5% SIS for net foreign exchange earning for the year. So as a hotelier, whenever we have foreign guests, they pay us in foreign currency, and that becomes our foreign exchange earning. We have some foreign currency expenditure, that is royalty or management fees what we pay to our operators. So on the basis of net foreign exchange earning, our entitlement is 5% of net foreign exchange earning.
For importing goods?
Yeah. No, these licenses are...
or you cannot get the scripts.
Yeah.
Right. So just to expand that, Amit, a little bit more, the SCIS final announcement by the Ministry in Government of India has not been made, and this is for the year FY19-20. That was recorded in our financial statements earlier because you take the earnings and the benefit of SCIS in the subsequent year. But with the government taking some more time to come back on the final announcement, it was only prudent to write back that income in our books, and on advice of our auditors, we've written that back. So the impact of that was 12.3 crores in this quarter, and that's why our EBITDA numbers did go down by 12 odd crores there.
So Amit, rates were notified by Ministry of Commerce up to FY19. We were expecting Ministry of Commerce will notify rate for FY20, but that did not come through till March 21 or April 21. Hence, we decided to expense it out and reverse that income accrual.
Just as an addition, the Hotel Association of India, CII, FHRAI, all of us are following up through the association to get this. And it's not just us, it's the travel communities, other exporters, all of them are faced with the same challenge. And once this gets announced, then we might be able to put it back in the books, depending on what the announcement is.
Sure. Thanks a lot. That's all from my side.
Thank you. Ladies and gentlemen, as there are no further questions, I now hand the conference over to Mr. Sanjay Sethi for closing comments. Over to you, sir.
Thank you so much, and thank you everyone for your time. On behalf of the team at Chalet, we would like to wish you good health, and please stay safe. Look forward to engaging with you in the near future.
Thank you. Ladies and gentlemen, on behalf of Chalet Hotels Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.